and welcome to this special conversation on CNBC-TV18 as we talk to the newest banker in town, Dr. Rajiv Lall, who continues to be Executive Chairman of IDFC at this point in time, but very soon will be carrying the title of CEO, IDFC Bank. Thank you very much, Rajiv, for your time today. Congratulations, by the way, on the bank license. Exciting times ahead, several different challenges, if I may put it that way, which also could be converted into opportunities. I think the first thing we'd like to know about is the transition process. You've already spoken of the need to dilute equity to bring your foreign ownership lower. You said you probably do it by August or September this year. Have you picked a route? Will it be preferential allotment? You need to reorganize your structure. Can you talk us through what structure you all have finally decided on? When the demerger of the bank will take place? And then I'll continue with the other questions.
Right. There are two types of things. So we have 18 months in which to launch the bank, which means that by October 2015 we must have launched. And in these 15 months we have to take care of two parallel tracks. We're proceeding on two parallel tracks. One is regulatory and compliance focused, and the other one is just pure business strategy, operations, and such like. On the regulatory and compliance front, there are several conditions that we have to meet in order to meet the RBI stipulations. So the first very important stipulation is that the promoter of the bank, which in our case will be IDFC, has to be a domestic entity.
Got it. So you've got
and so today we have 53 and some percent foreign ownership. That has to be diluted to that has to be brought down to under 50%.
Below 50%.
So for that we need to raise domestic capital. Most likely you'll have through a follow-on offering, an FPO.
So that's what you're doing, because in previous conversations with the media, in previous conversations you've also indicated that at some point you were looking at a preferential allotment or something like that. You've discarded that. So we can expect an FPO from IDFC between now and August, September this year, roughly, right? Okay, so that's the first question you asked.
Second, on the structure. On the structure, so it's a little complicated.
Break it down into little bits.
This is what will happen. IDFC today is a listed entity. It has the balance sheet business, which is under a regulatory dispensation called an infrastructure finance company. Underneath IDFC, the infrastructure finance company, we have three main subsidiaries. The first subsidiary is the IDFC Mutual Fund, which is a public markets asset management platform, 9th largest in the country. Second one is IDFC Alternatives, which is a private markets asset management platform. And the third is our niche investment bank, is our investment bank. These are the three subsidiaries. So what will happen as we transition to the bank is that IDFC, the parent, will remain listed, but our balance sheet business will very substantially get transferred to the bank. So IDFC will create a new company, which is the IDFC Bank, and all, for the sake of simplicity, let's say all our loan assets will transfer to the bank. So IDFC then becomes a shell. It becomes basically a holding company. Underneath IDFC, and in between the four subsidiaries now, the three existing subsidiaries and the bank, there will be an intermediate holding company.
That's the non-operating
finance holding company, NBFC. Once we are done with the restructuring, it will be a three-level structure. IDFC parent, which is listed, an NBFC that sits underneath a holding company, and underneath that, four subsidiaries, including the bank, and the bank will be listed day one. Okay, so it's a reorganization of the structure such that if you are today a shareholder of IDFC, once the restructuring is done, you will, in all likelihood, for every share that you own in IDFC, be given one share in the bank.
So you'll have a proportionate stake in the bank.
Exactly.
When do you expect the demerger, scheme of demerger, however you're going to do it?
So that's a court-assisted process.
Have you started working on it?
Yeah, we started working on it. So we must first do the, the dilution. then we have to create one more entity. So just to add to your complexity, there will be a fifth subsidiary underneath the NBFC.
Doing what?
And that will be the IDF NBFC, the Infrastructure Debt Fund NBFC.
Okay.
So what will happen is that actually some share of our existing infrastructure assets that are eligible for the IDFC NBFC will not go to the bank, but will go to the IDFC.
Why?
IDF NBFC.
Why?
Because for us as an entity, it is extremely helpful to manage the balance sheet size, the starting balance sheet size of the bank, because it actually reduces the cost of compliance.
Got it. So you want to have a lower proportion of infrastructure loans?
No, not a lower proportion of
lowest amount, right?
we don't want the largest balance sheet possible for the bank on day one, right? We want it can't be too small either, but we don't want it to be unnecessarily large.
Because of your priority sector lending requirements.
Because of the priority sector lending.
I get that. Right,
so to the extent that we can hive off some assets into legitimately into another entity regulated by the RBI, the IDF NBFC happens to be one such.
You can run a parallel NBFC along with the bank?
That is the only exception. The IDF NBFC is the only exception. Now,
this is the problem, the reason for why many corporates in fact withdrew from this whole bank license process, because of the inability to run parallel NBFC somewhere.
So in the infrastructure case, there is this possibility, and I'll tell you where it comes from. So the origin, the thinking, the policy thinking behind the IDF NBFC is the following: that as far as the RBI are concerned, they see it as from a risk perspective somewhat problematic that the bulk of infrastructure lending in the economy has been actually done by the banks, right? And why is it a problem from a risk perspective? It's a problem, so asset quality we'll leave aside, but actually the other technical reason is ALM mismatches. So the theory is that banks should do the financing of the construction of the infrastructure assets. Once these assets start generating cash, then they move into bond markets. So the theory behind the IDF NBFC is actually an intermediate receptacle. In the absence of bond markets that can...
They're allowing you this special dispensation to do this.
They're allowing all banks to do this. So we are no exception.
So only infrastructure loans?
Only infrastructure loans of a certain kind. So
which
they are
kind?
only post-construction infrastructure loans.
Got it. So of your 60,000 crore loan book, what percentage or how much will go into your IDF, NBFC, and what percentage will move to your bank balance?
So if you go by the very strict definition as it exists today, of what kind of post-construction infrastructure assets are eligible for the IDF NBFC, it amounts to a very small amount, only 2,000-3,000 crores.
That's it?
That's it.
So the bulk of it, 57,000 crores,
will
your loan book as it stands today,
still go to
the bank. Great. So now 40% of that needs to become priority sector lending, right?
Absolutely.
Superb. How are we going to do that?
With difficulty.
Okay. So in the short term, there are a couple of things that are being speculated about. Will you sell some of your infrastructure loan portfolio simply so that it becomes easier for you to meet that 40% priority sector lending requirement? So sell some of your infrastructure loan portfolio, buy some priority sector loans from other banks, and see if you can, in the short and medium term, meet the targets of 40% while you still actually build out priority sector lending. Is that what you're planning to do?
We have to operate on multiple fronts. So the first is manage the growth of the balance sheet. Don't get ahead of yourself.
Got it.
Moderate the growth of the balance sheet itself. Second is hive off whatever assets you can in the IDF NBFC, so that we are going to be
But
doing.
both of the only 2,000-3,000 crores there.
Yeah, so that's today. But you know, now we have a new government, and
so 15 months, even a new government, you know,
so
can't
they can become a little more relaxed about how they define.
5,000. It'll become 4,000, 5,000 crores, not much more than that,
so
right?
The third thing is we will start building a PSL book as of now. Remember that we don't have to be, but we have to demonstrate that we are PSL compliant by FY17. So we have whatever, 30 odd months to get to that point, and so we are going to be aggressively building out a PSL portfolio.
Organically?
So partly organically and partly we will purchase. We'll do both. And I think there are, again, how we purchase is also different. We are not given to purchasing at the last minute like a lot of public sector banks do to meet their March 31st
RDIFs or whatever, right?
criteria, etc.
They don't want to do that. So what
there is an opportunity to actually cut semi-strategic deals. Such as, so you can, we can actually negotiate with, collaborate with, partner with a number of NBFCs in the country that are effectively functioning as PSL engines, if you like, to microfinance. It could be low-cost housing, it could be unsecured loans to certain types of consumers, it could be lending to agriculture.
So you're already scouting for these loan books?
Oh, absolutely. Not just loan books to buy, but to cut strategic deals. So where in exchange for predictable, sustained financing, right, we get access to some of the origination that they do. So there are all kinds of possibilities.
Oh, that's nice. That also feeds into your rural banking.
Absolutely.
Without branching, if I may call it that, right?
So our rural strategy.
Branching is such an old-fashioned concept now.
Yes. So partnership is in, branching is out.